Ever seen an ROI look perfect on paper until reality hits? Let's uncover why nut numbers.
Welcome back. I'm Thanya, your international finance and commercial strategist. Today, we'll go deep into a critical idea that every financial leader, project manager, and investor must master: risk-adjusted ROI, or RAROI. We'll explore why traditional payback and ROI can mislead decision makers, how risk adjustments change investment logic, and what it really means when we say a project has a safe return.
Payback is not profit, it's just recovery. The real story begins after the money comes back.
Traditional ROI, return on investment equals net return divided by investment times 100, tells you how much profit you earn relative to cost. It's simple and seductive, but dangerously incomplete. It ignores time value of money, uncertainty, and risk asymmetry. Imagine two projects, both showing 20% ROI. Project A is stable, serving a long-term government contract. Project B is speculative, tied to volatile commodities. Would you treat them equally? Of course not, yet a simple ROI formula does. A high ROI with high volatility is like chasing yield without a seatbelt, exciting until it crashes. The missing piece is risk adjustment.
Fast payback feels safe, but sometimes it just hides small returns behind speed.
Many executives adore the payback period metric. How quickly do we get our money back? But a short payback doesn't guarantee long-term profit. Example: Project X pays back in 2 years, then flatlines. Project Y takes 4 years, but yields high profit for 8 years. Over time, Project Y wins. Payback shows speed, not strength. What we need is a measure that combines return, risk, and sustainability.
High ROI means nothing unless it survives stress.
RAROI introduces realism. It combines expected return and risk exposure into one frame. It asks, what is the return per unit of risk? Let's unpack the key approaches. A. Sharpe Ratio. Sharpe equals RP minus RF / sigma P. It measures excess return per unit of volatility. If the ratio greater than 1.0, performance is good. Less than 1.0, the project may be over-risked. B. RAROC, Risk-Adjusted Return on Capital. Common in banks and project finance. RAROC equals expected return / economic capital. It reflects whether the profit justifies the capital at risk. C. DCF with risk-adjusted discount rate. Here, we discount future cash flows using a rate that includes a risk premium. Higher risk projects, higher discount rate, lower NPV. This visualization helps executives see that risk isn't abstract, it's measurable and costly.
Don't just identify risk, price it.
Applying RAROI demands a shift in mindset. Stop chasing highest ROI. Start asking ROI that lasts. Step 1. Quantify risk. Convert qualitative risk into numbers. For example, if there's a 25% chance of a delay causing $1 million loss, expected loss equals 0.25 times 1 million equals $250,000. Subtract this from the expected profit. That's your risk-adjusted view. Step 2. Use benchmarks. Compare RAROI against internal hurdle rates, market indices, risk-free alternatives, e.g. government bonds. Step 3. Stress testing. Model what-if scenarios. Demand drops 10%, inflation rises 5%, costs delay by 3 months. See which projects still maintain ROI, hurdle rate.
A smart CAPEX isn't the biggest, it's the one that outlives its risks.
CAPEX decisions evolve when risk is visible. Boards begin comparing not just return, but return per risk unit. Key practices. Integrate RAROI into project charters and business cases. Require Monte Carlo simulations to reveal outcome distribution. Use risk key maps to visualize financial exposure.
Finance isn't just about profit, it's about endurance.
True leaders don't chase numbers. They build systems that keep those numbers alive under pressure. RAROI is how you see through the illusion of optimism. It reveals which projects will still perform when markets shift, supply chains tighten, and currencies move. Imagine two projects again. One with nominal ROI 25%, but no risk analysis. Another with RAROI 15%, but clear mitigation plans. The second is more investable, because it's predictable.
In modern finance, clarity beats optimism.
Let's recap the three truths. Payback tells you when money returns. ROI tells you how much. Risk-adjusted ROI tells you what's real. If you're leading CAPEX approvals or portfolio reviews, embed RAROI in your financial culture. It's how you protect capital and preserve confidence.
If this changed how you see investment, subscribe and join me, Thanya, where finance